Okay, great. Hi, good morning, everyone. Good afternoon to those of you in Singapore. It's an absolute pleasure to be here today to discuss with you some of the key trends which we are seeing on the real estate space in India, some of the recent events, how it has impacted asset owners, occupiers, investors, and what next from here. It's something which is absolutely topical, and we have seen a lot of recent trends, and I thought, there's probably no better than a couple of people who are there, who are joining for this discussion. Sanjeev Dasgupta, who's the CEO of Asendas India Trust, the first business trust to be listed in India, to be listed from India in the Singapore market. And Mike Holland, who's the CEO of the first listed REIT from India. Between the two of them, I'm sure they have all the answers for the questions you would have. As you can see, I was just talking to them a short while back. Both of them seem to be in their offices. Everything seems to be sort of getting back to normal. It's a few of us like myself who seem to be still working from home, but otherwise things seem to be sort of quickly but steadily getting back to close to normalcy. I don't think it's sort of normal yet, but things are getting close to that. Between the two of them, they have a presence in almost all the key relevant markets for commercial real estate in India. Both of them have a substantial commercial real estate portfolio with some exposure to some allied asset classes as well. So I'm sure they can answer any questions you may have on those as well. To give you the context here, it was both the companies listed with a gap of probably a decade. Asendas India Trust got listed in 2007. Embassy Office Park got listed in 2018. But one thing I can tell you is in that interim period, if there is one asset class within real estate which has seen substantial investor interest, that has been commercial real estate. And I say substantial because this is an asset class which has seen participation from a diversified set of investor base, which includes strategics, which includes some of the large private equity funds. It also includes some of the sovereign and the pension funds. So it's a completely broad-based, diversified participation from investors, which has been seen here. In addition to that, this is a segment which probably has seen a fair amount of external shocks over the last 10, 15 years. But each time, the sector has come out even more stronger, and it has come out well and continue to sort of deliver returns to the various stakeholders. We are probably passing through one such period. It's probably a phase which happens probably once in a lifetime, but we are all sort of hopeful that we will come out of this as well pretty strong. And based on all the indications so far, it looks like commercial real estate should again sort of come out of this as well pretty strong. What is also unique is, we have spoken a lot about REITs in the past. Globally, when we look at the listed real estate markets, REITs form a predominant part of the listed real estate capitalization. We probably, in a few years from now, may be in a similar place where the listed REIT capitalization could actually be higher than what you have for the listed space more broadly, or could be more than half of the listed space broadly. It is a pretty fascinating asset class in the sense it provides pretty attractive risk-adjusted returns in a low interest rate environment like what we are going through currently. It's one of probably the few asset classes which continues to give real asset appreciation, positive real returns, inflation hedge, as well as fair amount of liquidity. So this is something which is really caught the eyes of the investors. You have seen more transactions happening in the recent times. A lot of things have been happening, and it will be an absolute pleasure to hear from both Sanjeev and Mike in terms of what they are seeing on the ground, etc. What I will do is I will sort of pass it on to them. The way we have structured today is We will have a little bit of overview, which Sanjeev gives, and then Mike will also sort of give an overview, 15 minutes each. And then we will have a discussion for about, call it 20, 25 minutes, and we will open it up to the floor for discussion. I'm sure there are a lot of questions you have as well. So that's really what we have in mind. And with that, maybe I will sort of pass it on to Sanjeev.
Thank you. Thanks, Sundar. Thanks everybody for taking the time to join this discussion today. So, I think we are, of course, in a very interesting time, needless to say, and all of us, including us who are industry participants, investors, shareholders, have probably more questions than answers at this point of time. So if maybe let me just take a little bit of a step back and to talk about our business so that it gives you some context about how we've navigated the cycles. So Ascendas India Trust listed in August 2007. So it's almost now 13 years since listing. We are about 13 million square feet of income producing space with a pipeline of almost another 7.5 million square feet. Predominantly IT business parks. And more recently, about 2 years ago, we also diversified into logistics. We do think that over the next 2-3 years, in addition to our core IT park business, we'll also have addition of new asset classes, which includes further growth of logistics, industrial, and data centers. Through the last 13 years, before I just talk about the trust, Ascendas as a company has been in India for about 25 years. And we started as a developer, then we moved our assets into a private equity fund structure. And then all of those assets from the private equity fund were essentially put into a business trust listing in 2007. And we've therefore navigated quite a few different business cycles in India and also globally. We went through, the boom that the commercial market saw in India in 2005. We also navigated the global financial crisis, where we saw a sharp drop in occupancy between the years of 2011 to 2013. And then we saw the tremendous growth in this asset class between 2016 to 2019. So one of the things that we've always paid a lot of close attention to is that is actually seeing what the underlying drivers of the growth are. While of course we are all in the office space catering to IT sector, but how competitive is the Indian IT sector? How attractive is India as a base for foreign multinationals who come into India to set up their IT operations? And one of the things which we've seen as an evolution over this period of time is how India has migrated from a relatively low-cost offshoring center providing infrastructure support, Y2K conversion, as was the main business model in most of the 2000 to 2010 decade, to what we are seeing the last 4 or 5 years in particular, a much more value-add digital strategy, outsourcing model, where we're seeing companies that are trying to bring their financial services business online, retailers trying to bring their e-commerce work online, and all of this is actually even accelerated further through COVID. And most of that work essentially is today getting done out of India. In fact, it would be pretty difficult, one could say, for many of the global companies to really today run their tech operations without some sort of a meaningful base out of India. So that's how prevalent and dominant India has become in this space. What does that mean for the IT real estate sector? It has meant significant acceleration of space take-up. 2019 in particular was truly, uh, a validation of that. We saw record absorption, gross absorption of almost 60 million square feet, which is in the top 7 cities of India, which is truly a record. I mean, we've never seen these volumes of leasing ever in India, and a very healthy mix of occupiers. We've got the big tech companies, the FANGs, so to speak, the Facebooks, Amazons, Googles of this world. We have the big global banks. We also have the Indian companies like TCS, Infosys, and so on. So a very well diversified tenant base, which absorb that space. And uh, we therefore believe, I think, if we look at where we are today in COVID, of course, this has been a rough year where absorption has dropped almost about 40%. But I think the two interesting things that we are seeing, on the one hand, actually in the last 2 quarters, if you look at most of the Indian listed IT services companies as a proxy, most of them have announced 3 to 4% growth, which was well ahead of what it's year on year, and which is well ahead of what was being expected. Most analysts were expecting 0 to degrowth, and instead of that, they've seen 3 to 4% growth. And the interesting thing is the pace of new contract values that these companies are winning has gone up tremendously. I mean, you look at the top 5 Indian IT companies, their contract acquisition growth is almost between 15 to 20%. So clearly, it's again highlighting the relevance of India's strengths in technology outsourcing. And therefore, we believe that we shall see, as the infection situation in India comes under control, a meaningful growth of the IT commercial real estate sector. What we are also hearing from our occupiers consistently is that while there are obviously benefits to the employees in terms of not having to commute in the densely populated metros like Bangalore and Hyderabad, Mumbai, and so on, but there are some significant trade-offs. While so far most of them say that productivity has been maintained, but there are significant trade-offs in terms of teamwork, collaboration, especially in terms of onboarding new employees and helping to build a common set of values of the organization. All of those are proving to be challenges. So the underlying message is, are we going to see 80-90% of the people working from home? The noise we hear when we talk to companies one-on-one, unlikely. Will we see 100% of the people coming back to work? Probably not. I mean, our own sense is that we'll probably end up at somewhere between a 75 to 80% back to office in the months to come. The other point, that is the last point I want to make, is that is it cheaper for companies to work from home as opposed to work from office? If you look at the dynamics in India, where most real estate occupancy costs are at about $1 per square foot, there is very little arbitrage between making an employee work from home vis-a-vis providing them all the infrastructure and other support, also the allied challenges around productivity and so on. So really, from a cost saving standpoint, there is not much to be gained, unlike in the developed markets like Hong Kong or Singapore or New York or London or San Francisco, where the rental costs are significantly higher and the economic benefits are very, very substantial. So that's my overall point of view on where our business is, where we are, and where the IT park sector is in particular. And with that, I hand over to Mike.
Great, Sanjeev. Thanks very much indeed. Mike Holland here. I think many of the comments made by Sanjeev I would echo. Just some background about where we see the overall trends. COVID, important to note that in 3 of the 4 markets that we operate in, which is Bangalore, Bombay, Pune, and the 4th one being NCR, in the first 3, trends around cases have been going down now for about 6 weeks in Bangalore, about 8 to 10 weeks in Bombay and in Pune. NCR is on the rise, and that is a little bit of a worry given the climate and air quality issues. But the reason I highlight that is we noticed probably about 2-3 months ago that the behavior of our occupiers was often driven by the experience that they were having in the US and in Europe, and not by the experience that they were having on the ground here. So a lot of the policies that the international occupiers in our portfolio have are based around European or US perceptions, which are increasingly negative given the fact that Europe's having a second wave and US doesn't seem to have really got out of the first one. So positive trends in that regard in the urban centers of India that we're operating in. Definitely a higher level of mobility and back to work. I think some anecdotes, the Google Mobility Index significantly up across the country. Toll roads revenues are back to February levels. And we're seeing between 20 and 40% of our domestic companies, people back to work. And I stress that we're seeing a really significant divergence between the behavior of the international companies whose policies are largely driven by regional or global HQ. And I would underline also that I suspect that they're driven by the concerns around safety and litigation around safety in terms of back to work. But we're seeing at least 2 to 3 or 4 times as many employees of domestic companies back in the office as we are seeing from international companies. And examples in Bombay, which for us is a smaller scale market, more domestic facing market, we saw an increase of 87% on the quarter, the last quarter, in terms of people back to work. While in Bangalore, which for us is primarily an international tenant base, we saw an increase of 8% on the quarter. Across the portfolio, we saw 20%. But those divergences and differences between the behavior of international companies and the behavior of more domestic companies is really very significant. So, but we're also seeing, as Sundar said earlier on, it's not back to work as normal yet. But if you go out on the roads, we're seeing in one of our hotel properties a lot more F&B revenue side picking up. So there is a very positive move back in terms of activity. What does that mean for us in terms of leasing trends? I think we're still in that assessment phase. I refer to it as 3 phases. When the pandemic came into India, we had the lockdown end of March. So the first quarter of this financial year in India was completely in lockdown. There was a very significant pause in leasing activity while companies figured out how to keep their businesses going. The assessment of how they would move things forward, even at that time, a number of our occupiers were saying, we won't come to a conclusion on this until we've got people back in the office, until we're past the pandemic. Of course, the date by which everybody would be coming back to work has been constantly shifting. And again, you can take from the fact that one of those dates that people used to give out was Labor Day which is in early September in the US. It's not a formally recognized holiday or day in India, but that became, which is a reflection of the international tenant base, that became one of the milestones. I think that date now has really slipped to end of the year for most of those international companies. And then we anticipate that there will be an acceleration in terms of office demand by the end of this financial year. So we're moving now into early calendar 2021. So that pause, assess and accelerate. We certainly saw more leasing last quarter coming through compared to Q1. But pretty much any leasing that was done in Q1 were deals that were incepted prior to the pandemic. So roll forward leases. What we're pleased to see now is we've done some leasing that has been entirely during the pandemic period. The supply side, the forecasts are that has fallen back significantly. I think CBRE talk about a 2-year forward forecast that at the beginning of the year was 120 million square feet, the 2-year forecast, that's fallen back now to approximately 85 million square feet. So nearly a 30% fallback in supply. And that's not surprising given the fact that a lot of labor was on site, went back to their native place. Though that labor is now pretty much back and operating. Our sites are operating to about 85% of the original workforce. I think more importantly are going to be the challenges around liquidity for some of the developers out there who perhaps are not as well capitalized as some of the top tier players. That's a trend that we have talked about over a number of years. Over the last 5 years, there's definitely been a trend towards fewer, larger, better capitalized developers. We see that continuing forward. And again, we feel that will constrain supply in a positive way from an investor's perspective, because that will support rental growth. We're still in low vacancies in most of the markets that we operate in. The lowest being Bangalore, which is it has moved out from maybe 5 to 7% vacancies, but still a very healthy vacancy, and in sub-markets as well, like the market we operate in Pune, where AI Trust is also there. Low single-digit vacancies, sub 10% in those markets. And I think we feel probably the most important point of all these trends. One trend which really you'll find nobody who knows the market challenging this one, which is what Sanjeev alluded to, is that the occupier side, which drives the Indian office market, those largely international companies that are in the technology segment and all of the main office players in the REIT space would have 40-50% of their tenant base would be technology or technology dependent companies. All of those companies are reporting both formally and informally very positive prognosis over the next few years. Not just the services company, but the global captives that again Sanjeev alluded to, the companies that are supporting their business directly. They're setting up their own subsidiaries here in India. Some of those companies have had an absolutely fantastic couple of quarters, done extremely well. Even companies which one might be concerned about, for example, in the retail sector in the US, we've got a couple of tenants who are into omni-channel retailing. They use a lot of e-commerce. They've got a lot of flexible delivery models. They do all their technology over here, and they've had an absolutely cracking couple of quarters. So as the world gets more technology dependent, as businesses get more technology dependent, as the threat from cybersecurity increases, which we all know it is, and as work becomes less focused on a specific place and more geographically agnostic, we are absolutely clear that that is going to benefit our type of tenants, and that in turn has a benefit for our type of business segment, the office segment. So those are kind of very high level views around different trends, can give more data around each one of those areas. But a challenging couple of quarters gone by, for sure. We're not out of the woods yet, but the fundamental underlying industry that we cater to, our customer base, in good shape, and will be in good shape going forward. So a positive prognosis in our view.
Great. Thanks, Mike, and thanks, Sanjeev. They're very insightful. So to just take the discussions forward, maybe we'll just sort of go through, and we have a few questions for both of you, and there are also some of the participants who have sort of asked a few questions. So maybe I'll just sort of kick it off with some questions which I had in mind for you. So Sanjeev, maybe I'll start with you. I mean, obviously, when we look at what you have been reporting, obviously it continues to show pretty healthy collections from the tenants. All the tenants are sort of paying the rent, or most of the tenants are paying on a timely manner. Can you give, for our benefit, a little bit of flavor in terms of what is really happening in the parks? I mean, how much of the workforce is coming to office, or is it still a lot of people continuing work from home, but the tenants obviously continue to pay rent? And what's the level of activity within the parks itself?
So Sundar, what we're seeing is that I would say till about September, physical occupancy was somewhere between 4 to 5%. We are seeing a gradual uptick to about 10%. I would say that in the last 3 weeks, as the number of cases in the metros where we are present have been on the decline, and we clearly are seeing more tenants reaching out and asking us to help them with their transition back to office. So my sense is by end of the year, Q1 of next year, we do think that occupiers will come back to work in much larger numbers. And, this is obviously without taking into, when I say larger numbers, my own guess is it'll at least be at about like a 25% kind of a number. And this is, of course, without taking into account the availability of any vaccine, etc. I think if that happens, then obviously this number can go up. The other related aspect to collections is why are tenants continuing to, stay committed financially to the spaces that they occupy. It's clearly because in our conversations with them, what we see and hear is they do think that these office space is an essential part of their business model. They do have an intent to come back, and therefore they feel that it's, they don't want to go through the whole inconvenience of moving out and then going a few months later again investing in capex all over again. So that's the broad messaging. Of course, within this, I would also say that there are probably some small companies who have run into some severe cash flow problems, and some of that in a sense is already played out. And therefore, in those situations, I think those companies may choose to vacate, but that's still a very, very small fraction of the overall percentage of occupiers.
All right. And Mike, just carrying on with what you sort of spoke about, a lot has obviously been spoken about work from home, etc. But could you throw some light into the nature of work which actually happens in some of these parks? And do you feel, just given the whole physical infrastructure constraints and the social constraints, work from home could realistically sort of play out? I mean, I'm sure, the view in India could be different from what happens in other markets, but given the challenges and the nature of the work which happens, I mean, what is your sense on how much of this could actually play out?
Yeah, so thanks, Sundar. I should mention, I think I said that the back to work numbers in Bombay on the quarter were 87% up. That clearly doesn't include the investment bankers who have large apartments in Lower Parel. Take that with a pinch of salt. So look, work from home from the beginning. We did a lot of work around that, speaking to our occupiers, getting a feel for what it meant for the employees and the companies. And I think we concluded that there are five areas that work from home is challenging for the Indian demographic that works in our parks. So first of all, the physical side, the issue about, and this is more of, I also say, physically at home, often it's small apartments or it's 3-generation apartments with parents, maybe even grandparents living at home, children and so on. So often what we've been told by our employees and the people who run those companies, at home is often a challenging environment for people to work efficiently. There's also the issue that a lot of this young demographic live in rented accommodation or paying guest accommodation. And again, even more so, that is often not physically suitable. The second area that kept coming through was the issue about the digital side of things, whether that be bandwidth and supply around that and the way in which that impacted productivity. But the more relevant issue for the medium term is the issue about data privacy that I alluded to earlier on. So that's a second major piece that will surely come in, the issue about potential data breaches, and that has happened in the past, and that's the second area. The third piece that many people have spoken about as being problematic is the issue about career, culture and community. So the individuals who are working in these types of companies are at the early stage of their career. They are looking for a learning environment and an innovation environment, learning from a peer group and learning from their seniors and learning from the business culture. And that's kind of the other piece. Many business leaders talk about how do we build our company culture with people if they're never coming together into the office. And Sanjeev, I think, alluded to the oft-spoken challenge that as we hire new people, retaining that company culture has been something that people have spoken about often as being a problem. And then that final piece is community, which is, there's a business side of that and there's a personal side to that, where young people who are at the beginning of their career are building their network, they're building their knowledge base from other people, and they're building that within the company. So those threads come through very, very frequently when you talk to business leaders. And I've spoken to many of them actually this quarter. The challenge for business leaders that's coming through is that they have, in some companies, they've asked thousands of people to come back, and there is a fear factor around the safety of moving about, which links back to the fact that people are living at home with often with elderly families. So there's really no doubt that the workplace will retain at the center. What will change is there will be more flexibility about working hours, working days. One of the top 10 Indian technology companies, services companies, who's a tenant of ours, they've moved to a 5-day-a-week, 20% per day model so that they get everybody in during the course of a working week. And then when they feel they can step that up, they'll increase that. So as Sanjeev mentioned, very, very rarely do I hear of any company saying we don't need the office space. Particularly for these large-scale companies, they perhaps need a different type of office space that is more suited to collaboration, that is less dense. And you're already hearing about companies moving into lower density spaces, which is great because that was a very negative trend in my view over the last decade, where particularly the IT services companies increasingly looked at the office as a production line. You don't tend to find that densification problem in the global captives, because the global captives have always been about a qualitative aspect, less dense, higher quality workspaces. So many different activities, but one consistent message about the office at the heart of the workspace going forward in India.
Thanks, Mike. Sanjeev, just carrying on, now obviously when we sort of look at some of the recent reports, etc., there have been sort of pretty healthy, large leasing transactions which have been announced in the recent months. Now, how do you see the on-ground leasing momentum? I mean, it obviously takes a fair amount of time for leasing discussions to conclude. Are these sort of earlier leasing discussions which have just got concluded? At the same time, you also alluded to some of the IT services companies reporting new contract values, which are probably the largest in their history, right? So there's obviously healthy trends from new contracts also, which is there. But just in terms of when some of these could sort of translate into leasing momentum, is that already happening, or do you see some lag? And what do you make out of some of the recent large announcements which have happened?
I would say that the last 2 quarters ended September. I think most of the leases that happened were a follow-up closure of conversations that were going on, but had been put on hold because of COVID. This quarter, actually, interestingly enough, October onwards, we are seeing some absolutely new leasing activity that's beginning to take place. The volumes are still, of course, not anywhere close to what 2019 was, but the fact that companies are again coming back, looking for space, and thinking of expansion. And needless to say, the space expansion also involves CapEx commitment, because these companies quite often spend almost as what a developer spends on construction cost by way of fit out and electronics CapEx within the premises. So it's definitely a significant financial commitment for them. So I think that those are green shoots of a recovery. I think the key thing will be that the infection numbers continue to show a declining trend. I think that's important. And keeping that assumption as is, I do think that by June of 2021, we should see quite a meaningful uptick, because also what this has done is that it has given occupiers the opportunity to capitalize and freeze rents at somewhat lower levels than the boom time rents of 2019. So I think the smarter occupiers are also seeing this as a way to sign up spaces at somewhat lower rents with longer lock-ins. so that they know that, for the next 5 years or so, they are getting putting their real estate costs on a pretty, good, so at a relatively affordable base. So I think that's what I would say.
Got it. And Mike, taking forward the point you mentioned about the supply side disruption, and obviously, I mean, there's a lot has been sort of said about that. So, in that, given that background, given the financing constraints which people are facing, one, how are you seeing that sort of helping with the demand side or the demand supply disruption which is there? And two, a related question to that, I mean, could this mean that this could be an opportunity for people like you or the REITs in general to take on some more development? Do you think the risk reward plays out well from that?
Yeah. Okay. I mean, I think, so one, I've always, as I think you know, I've always been very positive about the way the REIT regs were structured here in India that limit us to, in essence, 20% of our overall portfolio value is the cap in terms of new development. I think that was a good, and you recollect that was 90 and it was relaxed, it was 10 and relaxed to 20. But that 80-20, I think, was a good landing point. It means that investors get fair visibility to a stable portfolio with a low proportion of development. And of course, development anywhere in the world is a proposition which is fraught with risks, and the reward needs to link back to the risk. We in Embassy REIT have always had a limitation to what we call on-campus development. So we're only doing new development within our existing business parks, and we believe that gives us a strength in terms of lower risk because we've got legal title on the land, we've got the building approvals in place, we're surrounded by demand, we've got a very strong balance sheet, lowly levered, we're able to borrow at pretty much the most competitive rates in the Indian market for this type of work. And so our development is a much lower risk type of development. And the converse out there in the market is you've got a liquidity challenges for many players in the market, expensive debt, perhaps already an overhang of that expensive debt, smaller scale product, one-off buildings as opposed to complete business parks. And we believe that the sort of product that we've been providing, Ascendus provide that all over the region, the large-scale business parks, we think that's the type of product that will prosper as we go forward. So all of those pieces put together, we believe, is going to result in a further tempering of the supply side, while we still have, an absolutely fantastic world-leading industry in our occupiers who are driving the demand side. So NASSCOM, which everybody I'm sure on this call knows NASSCOM, NASSCOM project for the next 5 years a 13% CAGR in the growth of the services that their members provide. That growth will translate into demand for quality office space. So we are in a blip. We have seen leasing pause, as I've said, in that pause and assess stage. There will be a catch-up phase. There will be changes in the type of office, the density, and there will be more flexibility. But fundamentally, all of the different components that go together to come up with the equation of office in India, I think have got a positive trajectory.
And Sanjeev, I mean, you too have been a large proponent for forward purchase contracts. I mean, you have done a fair amount of those transactions in the past. Do you see more of those sort of coming up, just given the overall liquidity environment? I mean, do you see a large opportunity out there?
So I think what we do have in the India right now is that on the one hand, for the well-capitalized and solvent developers, which actually is probably though a handful, there is tremendous amount of appetite for credit on the part of lenders. On the other hand, there is a much larger group which is significantly strapped for liquidity, especially for speculative new projects. So yeah, so in that given that environment, we are seeing a lot of deal flow in the forward purchase segment. But having said that, of course, I think we are we are taking definitely a more cautious approach, which with a lot more focus on risk mitigation in terms of micro markets where we want to do this, the counterparty, and so on and so forth. It's not that we didn't do it in the past, but at least in the past, we always felt that given the demand momentum, at least the demand side, the risks were lower. So that is something which we are underwriting much more carefully now.
Got it. And Mike, we again sort of touched upon this, the whole de-densification. Obviously, the office spaces did sort of come down sort of meaningfully. How much of this are you sort of really seeing on ground? Do you think people might reject the existing office spaces, or do you think it's more likely for new leases, like people sign up there, people will have larger space? I mean, how do you sort of see it sort of play out?
Yeah. So I'll give you the most extreme example. I spoke to a tenant of ours back in the early stages of the pandemic, large internationally recognized financial name. So their head of APAC real estate was saying that they could only fit 29% of their pre-COVID headcount into the office as under a revised plan, which was a less dense plan. Now, what we've also looked at with occupiers is whether or not they're actually making those moves and making those changes now. And generally the answer to that is no, they're not yet doing that. Certainly, if people are working on fit outs of new premises now, they have taken that into account, and there are some revisions going on, and we do have one tenant who's just coming up to complete a 300,000 square foot fit out. Again, in that global captive center, so already a pretty good quality type of fit out. I think you will certainly see companies using this requirement for de-densification, and they'll definitely be implementing it on the new spaces that they take up. You may well see a churn over a number of years from older buildings to newer buildings. So again, if I was holding standalone 10, 15-year-old buildings, not part of an overall ecosystem, I'd be a bit worried, and I had at least two IT services companies, I'd certainly apply some sort of risk to that. But yeah, I think the answer is most of those changes will only come when people make the next move. But I've also spoken to a business head, again, a company that employs 200,000 people in India. And the way he would describe it is that the work from home flex that gives, and that's now proven that one can do that, that will be the solution for much of this de-densification. So on the one hand, I sometimes talk about at the one end of the spectrum, you've got more flexibility and therefore fewer people in the office, and at the other end of the extreme, you've got the de-densification. So you need more office space. I think the flex will be in the middle, again, it conspires to lead us to believe we're comfortable about where we're at today and where things are going over the next few months, years.
Got it. Sanjeev, maybe just changing topics a little bit. I mean, we spoke at length about commercial real estate, but one of the segments which you sort of forayed into some time back was warehousing. Clearly, that seems to be a big beneficiary in terms of what's sort of happening with the broader industries and e-commerce, etc. So how are you seeing that segment in particular, and what's your outlook on warehousing in general?
So I must say that warehousing, of course, as far as the e-commerce part of the demand is concerned, has proved to be pretty resilient through COVID. I think we've seen a lot of take up by the two big e-commerce companies in India. On the other hand, of course, I would also say that the industrial segment, which also accounts for almost like 30-35% of warehousing demand, things had slowed down, but that slack got picked up. But we are again seeing a gradual recovery in that segment too. So my own sense is that the e-commerce growth in India, which has almost been like 60% in the last 6 months, which is a record, is probably going to continue as people have gotten more comfortable with digital retail. So I do think that momentum will continue. And on the other hand, interestingly enough, I mean, it may not obviously make it may not at times make the most headlines, but I'm seeing a gradual impact of the Modi Make in India campaign, supported by the US-China trade war. So we are beginning to see some impact or beneficial impact of that in terms of manufacturing FDI beginning to come into India. So if that momentum grows, then I do think that the next few years we should see a good take up on the demand side in industry, in logistics and industry. The challenge which I foresee, though, is probably not very different to the challenge that we saw particularly on the retail side of the business, retail real estate between 2005 to 2009, is there is too much capital chasing opportunities in this space, driving up land prices very, very quickly. And unlike the office side of the business where there is greater capacity to absorb rents, and that capacity actually increases as the rupee depreciates, because most of the occupiers are dollar revenue occupiers. In the industrial and logistics side, price sensitivity is very high, which makes land prices very, very critical. So that's the part about it, though, which does bother me a bit.
Got it. Very interesting. And Mike, I mean, if you look at it globally, I mean, there seems to be a fair amount of consolidation which is happening. I mean, commercial REITs have sort of combined with, say, retail REITs, logistics warehouses have come together with commercial. So at least in the Singapore market, I mean, there's been a few of those. Sanjeev, you're probably quite familiar, given Capital Land has been in the middle of some of those as well. So, I mean, do you see something like that sort of playing out in India so far? So far, if you look at the REITs in India, they've been sort of predominantly CRE focused, but do you think that could change with time?
I mean, it could change with time. I don't think that it certainly is not a part of our plan in the medium term. We don't have a plan around that. I think the beauty of the commercial office REIT from an Indian market perspective is the covenant strength that we have from our occupiers is really hard. It's hard to imagine a stronger covenant than a largely international tenant base using a particular market as their global hub for technology services in a world that is becoming more technology oriented. So now, if I look at retail, my covenant strength is the retailer who's running the department store. I can see in a more e-commerce driven business world how aspects of logistics you can have that good strong covenant. Residential REITs that are there in the US, it's hard to see how that could work in a market like this. Again, going back to covenant strength and management bandwidth and the legal system driving through, if there were disputes. So I think it's a long way away that we could be seeing multi-sector REITs. What you will see, I'm sure, is maybe the hybrid like AI Trust have done with their logistics warehousing deal. But I think we're a long way away from the level of sophistication and breadth that they have in the West. Bear in mind that in the US, REITs have been around for 50 years. They've only been around for real in India in the last 18 months, although AI Trust, of course, as you said, in 2007. So I don't think that that's a near-term issue. I just want to pick up on one of the things that Sanjeev mentioned, and I think he's spot on about this issue around logistics and industrial. Too much capital potentially chasing too thin a market. The barriers to entry to the types of office premises that large corporates are looking for are very significant. You need a large piece of land that's well located, often with a residential catchment around it, increasingly with a metro station close by. Industrial and logistics doesn't have that same level of barrier to entry. As Sanjeev said, the capital cost of the physical building is a much lower proportion of the total cost, and land is a very significant cost. And there are surely only so many players that can operate within the market. So, I do feel, and I've seen, and I think we've all seen over the last 15, 20 years, different new segments, relatively new segments, where there's a rush into that segment. And usually a few years later, that's followed by a tidy up or a clean up.
Great. Thank you so much, Mike, Sanjeev. With that, what I'm going to do is, there have been a few questions which have sort of come from the attendees here. Some of these I think have been answered, but let me just go through that and I'll sort of pass it on to you. Maybe, Sanjeev, there's a question around, over the next few years, how do you see the development mix within your portfolio compared to the completed asset mix? Do you want to sort of take that?
So we have a development limit of 20% by our incorporated in our trust deed. I do not think that we'll be close to that figure. My sense is we'll probably hover between maybe 5 to 10%, because because the developments tend to be finite. Most of them are within the parks. They get over in 24 to 36 months and get added to the income producing segment. So I don't think we'll typically be beyond 10% on development.
Got it. Thanks. The other question was on the low interest rates, both globally and in India. The rates have sort of come down over the last few months for sure. So I think, Mike, the question here is, how do you see the low rates impacting the development mix? I mean, do you see more capital sort of coming in for development? Is that likely to attract more capital just given the rate environment? And how do you see that sort of impacting REITs?
I think low interest rates are there, but to obtain those low interest rates, you need to have a strong balance sheet. I think that it is accentuating the strengths of a few larger players and will leave them in better health, but it will not be of great benefit to many other players who maybe are in the higher risk development world and tier. So I do think we're in a consolidation phase in the commercial office space. I mean, one thing that I would say, I was looking at a really super report from Cushman & Wakefield a couple of weeks ago about a 10-year projection on office demand around the world. And they looked at APAC and China separately. And they, with a very deep methodology, they came up with a conclusion that there was 700 million square feet of new office space to be absorbed in APAC over the next decade to 2030. And given the fact that India has historically accounted for 50 to 60% of APAC, excluding China absorption, you're looking at a 350 to 400 million square feet potential net absorption over the next 10 years. And they were taking into account work from home and flexibility and so on and so forth. And that all hangs together quite well when you think about our market today is 650 million square feet, approx. And so over the next decade, we may see that increase by another 50 to 60%. That space is going to be built and owned by institutional capital primarily, in my view. So the days of the pure trader developer that have happened over the last 20-year period and then 10 years since we started to see big listed entities. We're now moving into a new phase, which will be all about institutional capital, single ownership, much less in the way of strata ownership. That's how people have built space, and of course, strong demand is a prerequisite of it. So interest rates are nice to have, but I don't think that they, on their own, drive the development market. You've got to look at all the different factors: occupier demand, the consolidation that's going on in the market, standards, quality, scale, and so on.
Yeah, no, I mean, yeah.
Sundar, if I may just...
Sure.
I just wanted to make two quick points there to add to what Mike just said. One is, I personally am not convinced that low interest rates in India are going to be that way for very long. It's a high inflation economy. RBI is already struggling to prevent the rupee from appreciating. I mean, if they left it alone, the rupee actually would be a lot stronger, which again drives, runs counter to growing exports and so on. So question is, are these low interest rates sustainable for long? And the second question is, development is about risk. As Mike said, it's not just, so the cost of capital and the risk are really what are correlated, which is why development financing in India, I think, will always be somewhat expensive.
Agreed. I mean, yeah, I think it was probably never a question of capital. I mean, capital was always available, but the risk with development always was substantially higher than what you could face. I have one more question. I think a large part of this was probably addressed, but I mean, I'll still sort of lay it out to you. Do you see a trend in outsourcing increase with the advent of the pandemic? I mean, we obviously spoke about large contract wins, etc. But do you see a structural change in more digitization, digital transformation, etc.? And is that likely to lead to higher outsourcing? I mean, Sanjeev, you want to sort of take that?
Yeah, I mean, I would say that, yeah, I mean, I think that trend is here to stay. I think COVID has accelerated it in a significant way, but even post-COVID, I mean, I really think that the next wave, which is going to drive the technology capex, is going to be 5G. And just like how when 4G began, it was very hard to envisage what new business models it would create. But we saw the Ubers of this world become multi-billion-dollar businesses on the back of 4G. I think 5G is going to do a lot more in, whether it is, Internet of Things, whether it is gaming, so whether it's use of gaming technology in business applications. I mean, I think there's going to be a tremendous amount. I mean, already people are talking about capex of $50-60 billion in 5G in the first few years. So I think that is going to accelerate the need for more technology tools. And I can't see any country other than India just being able to provide the quantum of talent that is required to service that need.
Yeah, can I add a comment there? I mean, I totally agree with your latter point, Sanjeev, that there is no other geography that can satisfy the demand from, the technology devouring businesses of the world. But one caveat or comment, Sundar, I'd say your question, you said, do you see it increasing outsourcing? I think that's changed. Actually, what has changed is increasing offshoring, yes. Outsourcing, the trend over the last 5 years has been for many of these companies to bring things in-house, not outsource it. So the global captives, we saw, I think it was close to a 60% growth in the number of global captives in India over the last global financial crisis. Today, there's 1,450 global captive centers. So I think that we'll see, yes, there'll be growth in outsourcing as well to the services companies, but those captives will continue to grow and keep their value add activities in-house. Why, when I ask companies, why do they set up their own captive and not outsource it, or they bring it back from the outsourcer? It often comes about they want to put their company culture on the business and not be in what I sometimes refer to as a Henry Ford factory. They don't want that standardized service. There's some great things about standardized services, but they want it specific to their business. They want the employees to feel connected with their business and not as just an outsourced hire, because they feel it gets better quality and better productivity. That's the answer that I'm given. So I do believe that outsourcing will increase, but more so, I think it's about offshoring, and offshoring to the global center for English-speaking technology in the world. So I think it's, again, positive.
Yeah, absolutely. Okay, I think there was one more question from the panel. I mean, Gargi, someone wanted to ask a direct question, right?
Yeah, we have Anupam here. And Anupam, if you would like to ask your question, please.
Hey, Anupam, can you hear us?
Anupam, I think you're on mute.
Hi. Thanks, Gargi. Thanks, Sundar. Excellent discussion, and I fully agree with what Sanjeev said earlier, that the digital transformation which is happening across businesses across the globe, accelerated by COVID, is a big positive for IT companies in India. And, if you look beyond the short term, should accelerate the business in the medium term. And what Mike said about the global captives, we also see that when we meet a lot of services MNCs globally, that there's a lot of discussion about setting up new global captives or increasing the scope of activities of the global captives that they have in India. On top of that, what has also happened is that the technology and the break-even, technology has enabled the break-even cost and time for setting up a global captive in India to be reduced drastically. So vis-a-vis, let's say 10 years back, it's 1/5 or 1/10 in terms of the critical mass that you will look at. So I think that's a big benefit that we will see as we go along. And what Sanjeev mentioned earlier, it was just an observation Sanjeev mentioned earlier. We are also seeing a lot of manufacturing MNCs looking at China plus one formula for diversifying the supply chains and looking at India as a very, very feasible and viable option. So just to kind of give you an update on that also from the perspective of where ICICI Bank works. We work with CII for multiple initiatives to expand Singapore-India corridor, or ecosystem of investment, trade, and remittances, as we call it. And we work with a lot of funds across, sovereign wealth funds, portfolio investors, infrastructure funds, as well as private equity funds across their multiple requirements: FX, hedging, custody, LRD, arranger to the NCDs, and so on and so forth. And we, between us as well as the India team, we work very, very seamlessly as one bank, one customer. So I think we are quite happy to be associated with CII and this partnership we are looking forward to partnering with all of you for your India journey. Thank you.
Thank you, Anupam. So I think that's all we had. So before I sort of give my concluding remarks, I'll just put one question to both of you. If you were to sort of look into the future, where do you see the Indian market, the Indian REIT market 10 years from now? How many REITs do you see to be there? Sanjeev, you want to go first?
I think the size of the Indian market, be it office or other asset classes, is significant. So I do think I'd be surprised if we don't see at least about 8 to 10 listed REITs over this decade. Over the next decade rather.
Mike?
Yeah, I would think a similar number, 8 perhaps, and it comes back to the issue that the market is being taken, frankly, by the large-scale, well-capitalized owners, and that is what's required. But we will be a 1 billion square foot market for sure by then. 640 odd now. So you would expect that the top tier players who are here today, I think will dominate that landscape. It would be most surprising if there was a new player came in from outside India and managed to create something of the scale that we're talking about. So then if you look at who are the top 10 or so players in that market who would take that thing of being well capitalized and having a decent track record, there's probably only around 8 to 12 such players. So I think that's kind of where it'll be, somewhere in that number.
Okay, thanks, Mike. Thanks, Sanjeev. It's been an absolute pleasure having you all. It was a fascinating discussion. Clearly, what we are going through is something which we haven't seen in our lifetime, and we all hope, we probably don't have to go through a phase like this ever again. But clearly, through each of these, we we hope to come out stronger with our own learnings. The commercial real estate sector has been resilient. It continues to see positive headwinds as we sort of come out of this. Offshoring, outsourcing, all continues to be seen getting a big uplift. The overall environment also seems to be sort of favoring large, well-established parks, people wanting to have more space to work with. So while there are some near-term challenges, I think it seems like this asset class has a strong runway ahead, like it has sort of overcome various crises in the past, including the GFC. So it's been an absolute pleasure to get your insights, thoughts, different views, etc. And it's great to have you and listen to your perspectives. So thank you so much, Sanjeev.
Thank you, Sundar. Thank you, Gargi. Thanks, Sanjesh.
You.
Thanks.
Nice to see you, Sanjeev.
Thank you.
Thanks, Sanjeev.
Thank you.
Thank you.
Okay.
Thank you. Bye-bye.
Bye-bye.